And here we go. I believe, Dr. Anirban Mahanti, we are live. How are you going?
I'm great, mate. It's great to be live. Well, I'm alive and live. That's like two things at the same time. That's pretty good.
Yeah, it is. Two very good things, two very important things. I think you have to be alive to go live, although maybe, there's some sort of whiz bang thing out there I don't know about yet. How's your week been?
Oh, it's been good. I wouldn't call it great, but it's been good. How about you?
What makes it not great?
It's been raining.
Okay.
So I'm not generating enough solar power.
For yourself or for your house? Literally?
Literally for the house, like I like my batteries to be fully charged, mine and the real batteries. And yeah, it's, I like to also export enough so that I get some credit. I like to see that I'm being paid for the energy generation that I'm doing, all of those little things. It's nothing. It's like literally like, I'm complaining about coffee money, but it's the pure fun of seeing the sun do the work for me.
Yeah, I like it. We, Sophie, who was our kind of head of design for a very long time here at Rask, she said that she was 30% happier when the sun was out. So she tried to wrap a number around that, which is really interesting. At the time I heard that, I was like, 30%, that's pretty high. I don't think I get that much from the sun. But then I saw my doctor recently, did a heap of blood tests, and he said, my only prescription for you is more sun. So maybe there is something to it. Getting sun is important.
More sun or vitamin D. Or whatever it is.
Yeah, vitamin D. He said that's the only thing we could do a little bit of work on. So I thought that was really interesting. Just before we get into talk about stocks and whatever, just a reminder for anyone that's watching this live on YouTube, anything that we mentioned today is limited to general financial information only. So it's not specific to you, your needs, goals, objectives, and all that. You would need to see a financial planner for that information. Here in Australia, the rules are pretty strict. So we keep it general and investing related. Mate, we've got a lot to talk about today. I know you've been working on some stuff at Seven Investing. I've looked at a few companies this week, a few strange and bizarre companies. We've got a big merger or takeover that didn't go through. We've got some news from Blackmores, from Zip, which was interesting. It was about 4 paragraphs long. With one of the world's biggest companies. So that's always a bit of fun when you get those announcements. And we're going to dive into that topic we've been promising for a long time, which is basically how do you pick winners in an industry, a growing area, when you think, there's a thematic, how do you do that? If you have any questions for us and you are watching this live stream, you can just jump straight into YouTube there and drop a question in. I'll try and make sure we're also on Twitter and seeing if anything's coming through there. Okay, mate. So maybe just to kick things off, as always, what have you been working on?
Oh, I was going to say, why don't you tell us what you have been working on? Because you said you've been looking at a few different things. Let's change it up.
Okay, sure. Yeah, sure. So this week, things have been really interesting for me. In fact, the last few weeks, one of the things that's interesting about our business, thanks, Jay, for posing a question there. We'll get to that in just a moment. One of the things that's interesting about, I guess, business and investing generally is that when you invest in companies, I think it's a lot different to actually operating inside one. And what I mean by that is you can learn all these things, but sometimes you don't grasp the full realities of it. And so for me, I've read all the books about lean startups, about ways to scale and all this type of stuff. And we're going to get to that in just a minute, some of those books. But, over the last, say, year, Rask has gone, we went from about 10 people in our team to 1, being myself, when there was an existential risk that became a reality. And now we've gone back to 10 people or thereabouts. And throughout this kind of scaling process, things have changed for me, right? Like you've got to look inside yourself and see, okay, where are my skills? Where am I best suited? What can I do to unlock the team? And it's a totally different skill set. And so I'm still coming to grips with that. And I found that as I've gone through this process, I feel like I've become better at analyzing small businesses. So one of the things that I've been spending a bit of time on recently is just looking at private companies and potentially finding ways to invest in them. There are some really interesting crowdfunding websites and platforms here in Australia now. So, we get a lot of these offer documents, and there are actually rules under crowdfunding here in Australia that allow companies to have an option before they go to the ASX or to private equity or something like that. So you can have more shareholders, you can have literally thousands of shareholders in a private company, whereas that wasn't the case before this strategy came in. So we've been looking at a few companies in that space. I looked at a business called Kester Black this week, which is a cosmetics brand. It's like a vegan, pro-environment kind of cosmetics brand, which is a bit interesting. But also, if we're speaking of pro-environment, there's a company on the ASX called Vulcan, which I've been having a look at. And Vulcan was something that I was asked to talk about on AusBiz yesterday. And I've got to admit that this is an interesting business. It's got some pretty powerful backers, 1.6 billion market cap, and no actual real revenue because its project in Germany is still a way off. But it managed to raise $200 million in capital, which I was very surprised about. So everyone must know something I don't, but I think in these situations where you see the market cap and the share price performance like this, and the time until a project comes to fruition, such a long way off in the distance, I find people tend to overestimate the need to get in quick. Like there's a lot of water that has to go under the bridge there, right? So it's a really interesting company. I'm not an investor, but just really interesting. Get asked a lot of questions about it. So that's what I've been working on. Sorry for the long explanation.
That's very, 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 very interesting. Yeah, I like the private investment angle as well. Yeah, there can be some opportunities there. There are some platforms in the US as well. I'm actually a member of one of them called Microventures. What is interesting about Microventures is that you would find secondaries of companies that are not yet public, right? And it's like a secondary market to the company's primary market. Like, a company like SpaceX, for example, would, you can actually buy shares of SpaceX there.
Oh, right.
Yeah. So I actually
This is called Microventures.
It's called Microventures. Recently signed up to you need to fulfill criteria for being a first-ticket investor. So they have certain conditions that you have to fulfill. If you fulfill that, then it unlocks a few different options. I haven't actually made an investment yet because the reason I primarily got into that one is to actually invest into SpaceX if I could. I know actually a couple of people who have bought into SpaceX through there, and then and it has already gone up a lot because because they have private rounds, right, where they are raising money from other people, and then some internal folks might be actually selling their shares. Right. I'll just caveat more quickly that, if anybody's thinking about private investing, one of the things that they need to remember is that you could be locked out for a long, long time before you actually may be able to realize the value, right? What if the company never goes public and then you don't find an opportunity to sell those shares back via some secondary option? Then you're kind of stuck. You basically got paper wealth. Yep. Which you don't have with the public market, right? I mean,
that's a huge risk. Yeah,
that's a huge risk. Something to keep in mind.
Yeah, and I think that's why a lot of the times it is only sophisticated investors who can, even if there are funds that invest in private equity, they're typically sophisticated only for that very reason or wholesale.
Absolutely,
and that makes sense, right? Like a lot of people struggle to think more than 6 months. Let alone like 5 years, which is oftentimes the minimum term for a lot of these positions. So, and then, like you said, a lot of these companies that we're looking at in Australia on the crowdfunding side of things, they actually have really stringent like shareholders agreements or constitutions, which basically prohibit you transferring shares without offering them back to the founders first. So, and that's pretty normal. Like a lot of founders, like I'm in this situation too, where when I did a shareholders agreement for our business, I wanted to protect existing shareholders as much as I could. And so we baked in something like that into our shareholders agreement. And so it's normal, but for people that aren't familiar with that type of thing and don't understand kind of the legalese, it actually can be pretty, it can be a bit of a minefield. So obviously keep your wits about you. How about you, mate? What have you been working on? I've got a feeling, being the 1st of October when we're recording this, that this is some sort of special day for you and the 7 Investing team.
Well, so tomorrow morning in the US.
Tomorrow morning US time.
Tomorrow morning US time, we release the 7 Investing recs come out, right? So, we're putting final touches to our recommendations and so, writing it up, filming my video, the marketing video that a 2-minute clip that we do a less than 2-minute clip that we do for Twitter, those sort of things. Yeah, I'm quite stoked about the one that I've got this time, because it's an interesting little business, which how do I describe it? It's a business. It's very rare to find these sort of businesses which are, relatively small size still, in a US scheme of things. Should be large cap here in Australia, but fast growing, significant insider ownership, dynamic leadership, and profitable, right? Not just on an operating basis, but at the bottom line as well.
Interesting.
With excellent tailwinds, right? It's one of those things. So yes, I filmed here's the hint. I filmed my marketing video inside my Tesla, right? But it's got nothing to do with Tesla. so that's the hint.
Is it on Twitter yet? I'm trying to find it.
Twitter. Yeah, it's not on Twitter yet, because they'll probably get posted tomorrow, right? So
okay.
This is the heads up. So this is the tease of the tease. So this is a pre-tease of the tease. Yeah, but anyways, I think one of the favorite things for me is sitting through the stock pitches and this watching what is being proposed, and I really find that very interesting. And it's just interesting from an investor learning point of view. Like, I just look at I take it as, okay, what can I learn from listening to my colleagues, right, pitch their stocks? And I always learn something. And I also find just the different gamut of risk reward that people look at, right? There's so many different ways in which you can invest in the stock market. And I just every month I sort of realize, yeah, okay, that makes sense. And okay, I can see how that can be a 10-bagger. Maybe it's higher risk, maybe it's not. And I can see, okay, that doesn't necessarily have to be a 10-bagger, but it can still be a very nice market-beating investment, because it's less risky, steady, and well-known name and things like that. So it's just, again, different styles. It's really, it's very easy for me to dismiss some other style, but again, I still look at it and I say, okay, yeah, that presentation made a lot of sense. When I think there's a difference between pitching a name and pitching a stock with a presentation. They're two very different things. And I would dismiss some of those stocks saying, okay, not interested. But I said, okay, maybe I'm interested in this one. So anyways, that's my, I actually love, this towards sort of the end of the month is when, from an investor point of view, you get a lot of education, which is pretty cool. What else have I been? I've been doing something else, actually. There's been some. I'm going to actually be talking about this this afternoon with Danielle Ikue. And we're chatting about Tesla. But one of the things I've been doing is I've been doing some ROIC calculations over the last day or two, largely because there's been tweet going out about certain businesses and their ROICs. And so somebody tweeted out, actually I named the person, Mayur Taker, who I interviewed for a 7 Investing podcast. And I recommend people follow him. He's a fantastic analyst, really good thinker, and has a really unique way of analyzing businesses. And I learned a lot. We basically had a long discussion about Tesla, but he put out a slide, or he gave an interview with somebody else where there was a slide that talked about ROICs of certain businesses. So something like an Apple, according to him, was sitting at 42%, right? And the key thing there was how basically the invested capital is going down because effectively Apple is buying back shares, right? So if you've invested capital goes down, then your ROIC goes up because, well, you've reduced the denominator by buying back shares, which is, an interesting way of looking at it. But then, he was just looking at Tesla's and doing Tesla's computation. And according to him, I believe that requires some adjustments. Tesla is sitting at 23% ROIC, which is pretty phenomenal.
I've actually got a question for you on that, because you just said adjustments, and Julian's just asked, hey, gents, just wondering how you think about return on invested capital. Is it a metric more applicable to manufacturing businesses, or is there a way we can use it for SaaS businesses, capital light businesses?
Yeah, the capital light businesses, there's not, you would expect invested capital is going to be small, right? It's not, you should have very high ROIC in theory, right? So, I mean, for capital light businesses, I just look at operating leverage kicking in much earlier than.
So when you say operating leverage, what do you mean? But then if you're going before ROIC, what are you
I'm just looking at operating profit, and I'll look at, the operating profit basically scaling much faster than, say, sales, for example, right?
Yep.
And that's all I really need to see. I mean, theoretically you can do an ROIC calculation for anything, right? You could do an ROIC calculation for someone like Google, and it would make sense because, they also have huge investments in any company that becomes big eventually has investments in something.
Yeah.
Right? They have to invest somewhere. So you could theoretically do that, but that's how I do. It's ROIC, I think, is more interesting for like an Amazon style, a heavy, any business that requires, I guess, an infrastructure sort of investment. I think it's interesting for that. And I think it's interesting for just to gain insight into sort of the scaling early on, right? I mean, if the ROIC right now is, say, 20%, right? And if you realize that the business is still not fully leveraging the base of investment has made, then there's a lot more juice left in that lemon to squeeze, right? And that's basically the idea.
Yeah.
Again, it's one metric among the many.
Yeah, there is. Yeah. So Jay actually asked the question on this. He says, long time listener, first time asking a question. No better time, Jay, than the present. I would like to be able to analyze multiple companies using key metrics. Is there a tool that provides this info that I can export to Excel? Key metrics at a time. You probably have to pay for software to do that, right?
And here's the thing, right? So ROIC. So when I do my calculation, my results are going to be different from my viewers because I might not have made the adjustment that he made. I just looked at the formula and basically plugged the numbers using the cash flow statement and the balance sheet, right? And then, ultimately, I think, okay, so here's the thing I'll tell Jay. I think you can be number focused. Numbers are good, right? But it's like pandemic modeling. Here's how's that a switch. We are in lockdown.
Okay, here we go.
So pandemic modeling. So it's like pandemic modeling. We can say we're going to be peak high of this thing because the model said that. And my number one starting point of all models are wrong because by definition, models make assumptions. And when you start putting assumptions, stuff is going to be different from what the reality is because you're never going to be able to, fully incorporate all the reality. So the importance of model is really to get insight. Right. I call looking at models and figuring out, okay, what's the absolute high? What's the absolute low? What's like basically asymptotic analysis, as the engineers would call it. It's very useful because it gives you an understanding of the limits. But then I think you want to be practical in your analysis, right? I mean, the P's don't tell you everything. The operating leverage doesn't tell you everything. The EV doesn't tell you. EV over S doesn't tell you everything. The growth rate doesn't tell you everything, right? There's a lot of soft stuff that matters. And I think all the big winners that I've had, the soft stuff has mattered way more. Like the way I've looked at Apple, you could not have looked at that using a metric. There was no metric. There's no metric that says that Apple is a human-computer interaction company. And therefore, so duh, what do I do? You can say network effects and this and that, but there's just no way. So I think, the best thing, it's just like looking at human beings. You have to analyze the package and there's no one metric to... Right? Because if there was a metric, then you'd say, you went to Stanford and therefore you're great. But most of the great entrepreneurs did not go to Stanford, or they went to Stanford and dropped out.
Yeah, they left. Yeah.
They left. So,
maybe you could mine that. So when they left, which semester, and then
and then exactly. So that's the thing. So I think you have to use. I find there's no single. It's again. I'm not saying the metrics are not useful. They are useful to get some insight, but I would not want to be. I never screen like that. That just does not help.
Yeah. I tend to use a softer approach as well. So reading and following other investors or, I don't think I've ever been a fan of screens, but you can do it. And, we do say that history doesn't repeat, but it does rhyme. And in companies, there are certain factors that you look for, and many quant funds have done this and kind of mined it and arbitraged it out of existence in many instances. But you can use things, I think if he's looking for Australian, just in terms of software, Jay, you might be able to use something like simply Wall Street or even the ticker terminal. Maybe, you get expensive if you start talking about Cap IQ, Bloomberg, and I'm sure I'm missing a heap, but there are plenty of sites that have the ability to export to Excel. I know there are plugins for Cap IQ into Excel. I don't use it myself, but you can do things like that. The ticker terminal is pretty cool. Ticker TIKR. I think it's created by Bobby out of the US. I was chatting to him on LinkedIn not too long ago, but that's just some resources. And I agree, because we had an episode recently where we talked about the different factors that we would, if we could only pick 3 each, what would we pick? And they were kind of similar but different. And we would use that basically as a list to then go and do the research. And I think particularly newer investors often think that the end point is the number. Like that's because that's what we're taught, find the number and therefore that equals a good investment, but not necessarily. It's kind of the other way around. So really interesting.
Can I add one quick thing? Another thing that actually has resulted in this sort of thinking is that a lot of places people ask, what is the valuation? And, see, my valuation is $30 and therefore I sold the share. So therefore I think it's overvalued. And so here's the one thing. I think the moment you put a single number to something, you're creating sort of, I think, a Pandora's box. There's no way you could basically, you'd have to have a confidence interval, right? You'd have a range in which you say, my range says I have high confidence that something is valued in this range. But the moment you pick a single number, I think you are, and then you sort of think about that single number, you get into this mode where, okay, you become very number focused, right? And then you're losing sort of sight of the other things, but very useful for screening. You get a list, I think. A lot of things are useful for screening. I
was asked the other day, if you have a private company, so say you buy $5,000, $2,000 in one of these crowd-funded companies that are private companies, how do you do a valuation? And how do you kind of determine what's a price to exit? And my response to that was basically, well, what is someone else willing to pay? And if you think about a very illiquid market, we know that stocks you can typically buy and sell on the same day. But imagine if there's only one buyer and one seller every 3 months. How do you determine a price? And basically you have to come to an arrangement with that person. You have to convince them what it's worth. And if there are 3 other sellers, they'll try and convince them of something too. And so at the end of the day, in illiquid markets, basically the price is set based on the last sale. And the last sale is typically based on whatever your valuation is. And everyone can be independent. It's just that the law of big numbers apply to stock markets. And we tend to, coalesce buy orders and sell orders around a price. And so at the end of the day, valuations tend to be whatever you believe it to be. And, you can have a range, as you said, but even just as, if you put 3 investors side by side, they probably all have different ranges and valuations too. So I think that's a worthwhile point to just add on in there as well. But hey, you and I feel like we could go for days on this. We've got a couple of news stories we want to talk about. The first one is Zoom and Five9. I think you're a bit more familiar with this business given what we talked about recently with Zoom. I know that from a high level, I know what's kind of going on, but maybe you can just fill us in on Zoom plus Five9, what that meant and what transpired.
Yeah, so Five9 is like a contact center type of business, right? Basically, provides contact center support, if you think about it. And it kind of makes sense that those 2 companies would work together, right? Because audio, voice, and contact center makes sense. I think in this particular case, and it was probably going to be the largest acquisition or maybe the biggest acquisition that Zoom has ever made. It was valued at something like close to 15 billion US, if I am not mistaken. And I think the problem here was a couple of things, right? One was the deal was a stock deal. The premium was not that high.
Right.
And the other problem is that if the currency which you are using to pay for it, if that currency drops in value, then the corresponding value that the buyers are getting also drops. That's basically what happened here, right? So Zoom didn't have as great a quarter. Well, that's my interpretation of the events. Didn't have as great a quarter as one would have expected, as the analysts expected, and then maybe they didn't guide for as strong a forward guidance as the analysts might have wanted, and that resulted in some resetting of price targets and selling of shares and people repositioning their positions and things like that. And Zoom basically has been on sort of a downdraft from a share price point of view. That of course meant that the Five9 shareholders are now getting a poorer deal, relatively speaking, right? So what is interesting, I think, is that the shares of Five9 were not quite trading exactly, they were sort of following along maybe the Zoom pricing, but there was, as one would expect, that there is a potential for this deal to not go through. Maybe that was already being baked in by the market participants to some extent. And I think basically they feel like they're not getting enough of a premium is my guess. And that's primarily the reason. I think they're just basically saying, okay, we may be better off being a separate company. What I think is interesting is that if that is the, I think Five9 shares went down actually a couple of percentage points in post, in the after hours trading when this deal was announced as breakups happened. I would have actually thought it would go up because if the market was hesitant about the deal and then the deal is now over, well, then Five9's future is independent, right? So one would think that, they were rewarded for it. And commensurately, I would think that Zoom's shares should go up now because now there's less dilution, right? So, but anyways, I would not have ever thought that this would not go through. I almost thought it was a done deal. So I thought it was interesting that it didn't happen, because the shareholders, decided that, they're not getting the deal that they wanted. And I think there's some proxy voting issues and stuff like that involved. So some proxy organization has gotten involved in this deal, and they basically, pushed forward with the agenda of not making the deal happen, which I think is interesting.
There's also something else which is really interesting, and maybe I'll just add some context to this. When I was doing an interview with the CEO of an Australian tech company, which does a lot of its business in the US, so it's based here in Australia, but its primary businesses are in the US and accounts in US dollars and whatever, and they deal with big infrastructure companies and organizations out of the US. And I dialed into him on a Zoom call, and he said to me, "Oh, we don't normally use Zoom because we're not allowed to. The big companies in the US don't allow us to send our data through Zoom." I thought that was a really interesting comment. And then so this Zoom deal, there was actually something going on in the background, which was, I'm just going to quote CNBC here, a committee formerly known as the Team Telecom pointed to, quote, foreign participation in a letter it sent to the Federal Communications Commission about this deal, because Five9 has operations in Russia and Zoom has research and development staff in China, which is really interesting. So this deal was kind of getting analyzed from multiple perspectives. Obviously, you've got the companies and the shareholders, then you've got the proxies, then you've got the regulators. This was a really interesting deal all around. So fascinating stuff. I was trying to come to grips with the deal in terms of what it meant strategically for Zoom. I could understand why Zoom wanted to have more focus on enterprise and facilitate that, because they've got like the Zoom phone and they're kind of replacing Cisco in basically every sense around the office. So I get that, but the call center angle was a little bit different for me. I wasn't sure that Zoom would go down this road. I thought maybe there might have been another strategic partner that could have got them further into enterprise, because, you and I are doing this through Zoom right now, and then that streams to YouTube. But outside of this, I don't use Zoom for anything, right? Like nothing.
Yeah.
And I think a lot of businesses are like that. Whereas you look at, say, Apple or Google Meet or Microsoft Teams, they're basically like an all-in-one solution. You don't need to create a new link. And I know we've had one listener come in and say, you can actually get a Chrome browser add-on for Zoom and make it all work together. But I've always found that a little bit interesting. And I thought this deal, from that perspective, I was just trying to get my head around strategically where they were going. I don't know if you made heads or tails of that.
I mean, like these sort of you're right? I mean, these sort of acquisitions are maybe, they're not directly complementary, right? So they might run the two businesses separately, then try to butt heads and try to figure out, okay, well, where's the common ground? One thing that, so I think that the Cisco angle where you're replacing all the telephony infrastructure in enterprises, then you have the opportunity of saying, okay, you want call center support. We can actually inbuild that with Zoom for you. Sure. So, let's say you're Qantas, right? I mean, you need telephones and you want call center support, and you can provide both. It's a flimsy argument. Then you could, sort of say, we'll top that with sentiment analysis for, your customers and things like that. Whether they're happy, whether they're not, whether they're angry. You can build AI on top of it and things like that. That's what it's not miles off, but it doesn't seem. I mean, as you and I have previously talked about, right? I mean, the natural partner would have been something like Slack. Like, I mean, what seems to be missing from Zoom and from Slack? Slack doesn't have video capabilities. every small now. Large. What is it? It always had, but it was not ever any good.
No,
the question is it any good? Right?
Yeah.
And so the two things would have been complementary, right? And then one thing, of course, we haven't, we have to try out whether the new FaceTime allows us to record excellent videos now that it, and if it does, maybe you don't need Zoom. I don't know.
Yeah, true. Hey, the next topic is an interesting one, which is an Australian-centric one, I guess, but for Australian business, but launching overseas, which is Blackmores going into India, which is an interesting market because for those who don't know, Blackmores' history, being a vitamins creator, provider, was started off in China really, really well. It was all the rage for a very, very long time. And like infant formula providers gone after it, it actually kind of fizzled out and the company kind of fell in a heap. So now to be going after probably the second biggest market, at least by population, is a really interesting move. I'm not sure if you made anything of this. I don't really follow Blackmores that closely, to be honest.
Yeah, I don't follow Blackmores. I think the move, so you made an interesting comment, right? The second biggest market. So there's this general thing that I think companies think that, the Indian market is large, right? In terms of population, 1.4 billion people. But there's a big difference between the Chinese market and the Indian market. For example, the Indian market is very price conscious. So you can't sell them premium. Of course, there's a small population of people who'd be interested in buying a premium vitamin, but most of the people are going to be buying vitamin from, a company like Himalaya, which is local, which will sell it for 100 the price that you'd be able to sell it for. And how do you compete with that? And they'll probably make, their packaging look fancier than you. I mean, that is the problem. So it's a very price conscious market. The other thing is, I don't know so is there any brand value from an Indian consumer point of view, right? They probably don't even know what Blackmores is. So you'd have to build up the brand. That's a hard ask. It's not like Nike going, everybody knows what Nike is. So there's an aspirational brand, right? I mean, people don't have iPhones in India because they can't afford it. Because if those people could afford it, they would ditch their cheap phone and get an iPhone. But the iPhone is very expensive; they can't have it. Right? The same thing people wear Adidas and Nike and the others, right? I don't know whether people really care about whether it's vitamins from Blackmores or Himalaya or something else. So I think it's going to be a tough market. And it's definitely very unlike the Chinese market, where they have a fascination for premium, clean, green, and, also, Kiwi and Australian products and things like that. So it's going to be interesting. It's going to be an interesting one to watch.
Yeah, it is. I was just saying that the share price has fallen in a heap recently. That was comparing it to the 2018 highs, which was around about $175. Midway through 2021, it was down to about 66. But it seems like in recent times, it's actually reported some growth from its international segment, including China. So maybe things are starting to turn around there. It's a really interesting business just because it's a vitamins business, and yet it is a pretty large business, at least by Australian standards. So here in Australia, it's a very strong brand. Obviously, you see it at every chemist. It kind of has to be there alongside some others like Swiss. So really interesting. Again, I don't have any special insight, so I can't tell you what I think of it necessarily longer term, but just a really interesting business with a strong brand locally. The next one that we're going to talk about, which is another stock that's equally interesting, if my comments about Vulcan, which was the company that is $1.6 million, billion dollars, and not $1 million of revenue yet, raised some eyebrows amongst the community. I think, any type of comment that I have about Zip is probably equally likely to raise a few eyebrows and a few comments on social media channels. But basically Zip, which is a buy now, pay later service provider, came out and said, we've entered an agreement with Microsoft to integrate Zip into Microsoft Edge shopping experiences. So Zip, I'm reading straight from the announcement, is pleased to announce that it is entering an agreement with Microsoft to integrate Zip technology into the shopping experiences within Edge. Beginning with the US market, there are more than 1.3 billion devices running Windows 10. Windows 10, that's a different term. So for those of you that are interested in language, Windows 10 is not necessarily Edge. So interesting there. The new Zip functionality is being tested during the Q4 and could launch as early as November 2021. The comment here is that Zip provides customers with a transparent digital payment solution option, and we're excited to integrate with the shopping experience in Microsoft Edge. I'm not sure if you probably see this everywhere you go, but for those of you that don't, you can actually pay with your browser in some respects nowadays. So if you have a Chrome browser and you've got a wallet set up, I don't know if you can do it with Safari and Apple yet, but in many instances, depending on the browser you use, you can get different options shown at e-commerce sites. So for example, if you're on Chrome and you're on our website, the Rask website, and you pay for something, you might see PayPal natively inbuilt, and then it automatically registers that you've got a PayPal extension or something like that, and it automatically pays and all that sort of stuff. So this is an interesting move because if it is, a big deal, then a buy now pay later service like Zip will actually experience, significant growth, I'd imagine, from an operation such as this. But very light on detail for partnering with one of the world's biggest companies, a grand total of 4 paragraphs. So yeah, I don't necessarily know what to make of this, but I know the buy now pay later sector is what we've been talking about a lot lately. It's been heating up. What I would say is that it seems very early on. So many companies love to name drop, of course, and to talk about opportunities that they've forged with big names. I remember one going back in time, which was with Amazon. And this is an extreme example. So I don't say this is necessarily for Zip at all. I don't say that. But the extreme example that I have from the past was that a company announced a partnership with Amazon. And then that effectively, there was a video that emerged that said the deal was effectively could have been written on toilet paper. So, but that was enough for them to announce it to the ASX. And so, you've got to just be mindful that when these agreements are announced, are they material? Yes. Okay. Let's see some revenue before maybe we get ahead of ourselves. But Zip does have a really good track record of partnering with some big companies. I believe if you go to Amazon, you can use Zip. So really interesting deal. And my kind of high level takeaway is that it's basically becoming a 2-horse race here with Afterpay and Zip. That's probably my big takeaway. There are some players around the outside. I'm not sure how closely you follow buy now pay later, but that's kind of my surface level kind of discussion.
So I think a couple of things I'll just quickly say. I don't follow it that closely, but yeah, I think buy now pay later is gaining momentum in the US, right? So that's a very big market where it's gaining momentum, which is very, very interesting. So Zip is doing what it can. Afterpay has already made a deal with Square. I think right now I'd say that it looks like Affirm, which is a US based company, Zip and Afterpay. So I'd almost say Afterpay number 1, Affirm number 2, maybe Zip, close number 3. These are sort of the leaders in that space. How this is going to shake out, it's very hard to say because as you said, right, it's still very early days, right? Like PayPal has its own buy now pay later offering, right, that has launched. I mean, there's no reason that other payment providers can't launch their own operation. So again, very interesting, early days, lots happening.
And I think there was an announcement not too long ago about Apple potentially moving into the space too. Basically being able to just facilitate that through another bank. So you basically have the merchant bank and then it's provided through Apple Pay. Obviously, Apple has cards and the like, so it's not necessarily a massive extension for their ecosystem to do this. But yeah, it's a very interesting space. And I think at first I disregarded a lot of the buy now, pay later because I was thinking from a financial educator perspective, kind of the impacts on the community, and I thought it'd be heavily regulated, but it really hasn't happened. We haven't really seen any regulation at all. So these businesses have been able to thrive and rally those underlying sales, which of course turn into revenue for these businesses. So it's really interesting. Zip is now a near $4 billion company. And it seems to be making all the right moves alongside Afterpay, but obviously Afterpay, which we've talked about, is getting taken over by Square. So maybe it finds a suitor in the US. Maybe it doesn't. Yeah, Affirm seems like an interesting one. Obviously floated not too long ago as well. I'm just going to bring this up here. Yeah, it had a bit of a shaky start, obviously, but it seems to have come back. And I think, there's a space for a lot of these providers. It's just a matter of, do any of them get gobbled up before there's a chance for them to really become multi-baggers? I guess we'll see. The next topic that we want to talk about, which is probably one that we've been alluding to for a while now, which is basically, how do you pick winners in a growth industry? How do you identify opportunities? So, for example, you wrote a brilliant report recently, which is about zero trust computing, about cybersecurity. That's a really interesting, thematic and sector in general, and trend that's going on throughout not only markets but also through just our general day-to-day business and consumer lives. But many investors often come up to this point when they think, okay, so I can get an ETF to give me exposure to the broad market. But, I've got history is littered with these examples of multi-baggers, really extreme companies that have provided magnificent returns for investors. How do I go about trying to identify which company that's going to be? Now, this is there are books written on this one topic. So we're going to try and give our perspective on it, but maybe throwing it over to you, mate. How do you approach something like this? Because I know you do a lot of work in these really interesting industries.
Number one, the number one thing I'll say is that it's very hard to, consistently identify those large multi-bagger opportunities, right? So let's say you said zero trust. So the zero trust report, if people wanted, they can still grab it from the 7 Investing site. But here's the thing, right? So zero trust has got multiple components. So zero trust is basically a type of security framework. It's a modern security framework that enterprises should adopt, and sort of becoming the de facto standard. And now it is a standard, but there are many different components to it, right? So how do you achieve zero trust if you are looking at individual devices and endpoints? How do you look at zero trust? So when I say devices and endpoints, what I basically mean is, how do you think about zero trust if you're thinking about your computer, your laptops, your smartphones and things like that? Then there's, of course, some IT infrastructure that you might be housing, some internal applications that you might be housing. How do you think about that? If you have got multiple sites that you want to link and have secure links and secure communication between these, and you want to achieve zero trust type framework, how do you achieve that? These are different problems that need to be addressed, right? So for each sort of problem, you can find a solution leader, and you could bet on that. And I think that's been my strategy, is to find a particular area and then find sub areas in them, and then identify who I think are the leaders. And sometimes you might find multiple leaders that, they all overlap with each other, and then sort of pick those. So I'm never really trying to say at a very high level. So I guess just to backtrack a bit, we could say cybersecurity is a huge area. That's a huge, big area. And ask me to pick one cybersecurity stock that's going to be great. That's very hard. Right? Because then what you need to really know is that what sub area of the cybersecurity space are you really focusing on? Because typically when the area is that big, most companies tend to focus in or hone in, unless they are like a large cap. Like if they're a Microsoft, then they would have, their hands in different pies, in different, places. So I tend to go into the sub area and then look at the leader in the sub area and basically, back the leader. And I would build a basket, right? So I would pick sub area 1, sub area 2, sub area 3, sub area 4, and I'd pick a bunch of stocks in that area. And you could expand that argument to software as a service as well, right? Software as a service is a very general term, right? It's a modality, but then software as a service can be used for security, can be used for human resources, can be used for accounting, can be used for so many different things. Then you could pick which areas have the biggest TAMs, or sub areas have the biggest TAMs, and then try to find the leader. Right. And generally backing the leader seems to be a good strategy, gives you a better chance, at least in my opinion, about finding those big multi-baggers. So that's sort of my strategy. Again, not trying to, let me put it this way. I never try to be too I don't necessarily have to be concentrated. So I don't try to say, okay, I'm going to go in with this and I'm going to make this a 20% position because I have very high conviction in this. Instead, I would say, okay, I like these 5 different ideas and I'll pick all 5. And, that's been my approach. Curious to hear yours though.
How do you, can you, maybe an example might illustrate how you find the winner, like who is winning? Are you going off size in terms of, just the sheer revenue that this company generates? Are you going off what you hear from other people, or you test the products? Like, how do you determine that?
Right. Okay. So this is a hard one, right? This is hard because it depends a lot on a particular area. So let's use security, because you're talking about security, and I'll talk about a particular company called, say, Zscaler, which does enterprise level security for what they call securing the edge of the network. And so the solution is really clever. What they do is they basically run a proxy globally, right? So they run multiple proxies, and what proxy usually does is you could have a forward proxy or a reverse proxy. I'm going into too much technicalities, but a normal proxy was used in the good old days for caching web content. So the idea of a proxy was to bring content closer to the user, right? To enable the user to access that content quickly, right? So instead of the content being always delivered from an origin server, they're delivered from, close by proxies. Here, what they've done is they're taking this idea, but they reverse it. So what they've done is they've put proxies around the globe at major points of presence. That basically means they basically put them at the locker room of various telcos. That's another way of thinking about that, or big, large data centers in big cities. And what they're doing is effectively all communication that your company's devices need to make go through this data center. And then basically once they hit the data center from that point on, it can analyze the traffic going upstream and then analyze the traffic going downstream. So it's basically doing deep packet inspection. And it can do that because it's running this basically packet level inspection, including encrypted data, because most of the data is HTTPS, right? So it can do that for all flows that are going through the network. Right? Now, how do you figure out that this is sort of a leader? Well, a couple of different things you can do. One is you can, of course, try to look at the technology and see if it makes sense, right? That's one checkbox. The other thing that you could do is you can look at something like a Gartner's Magic Quadrant, right? So Gartner has a framework where they put they would have a rating or ranking for different companies in a particular area based on who's the leader, who's the follower, right? And they're usually very, very good. So that gives you a good sense of what the competition landscape looks like and who's in it. That gives you, an idea of which companies to look at. And the third thing you can do, and this is where I think research comes into play, is you look at security, right? And let's say you Zscaler, but you can look at Zscaler's competitors, and you can look at what I would say the legacy players. So you can look at the legacy players and compare them with the modern players, and you can see what the conference calls are saying, right? And so in the good old days, security was a hardware play. Basically, you installed a lot of different hardware boxes. Now security is a software play because the hardware has been disrupted, right? So a combination of different things, and of course, then revenue growth, leverage. If you're signing big customers, that's a great sign. Like, if you're signing Fortune 500 companies, and a lot of them, well, that's a good sign. So a lot of different things. Testing is really hard, right? It's very hard for an individual investor or a small investment house to actually test an enterprise grade solution. Most of the time we would not be using them, or even if we use them, the scale at which we are using them is really small. It's very hard to actually tell, is the solution significantly better? So a lot of reading technical information and things like that. That's, again, I don't have a formula per se. Again, it differs from company to company. I know this is an unsatisfactory answer.
No. I think it's really interesting, and I think it provides a great kind of base for people to work to. And just acknowledging that it's not always a science in just pick the biggest one and that's the winner. That's not necessarily how it works. There are many different examples. One of the recent examples might be, say, Fastly versus Cloudflare. That's been a tale of two companies. So that's really interesting too. I'm going to refer back to the original Guerrilla Game investing book, which was Investing in High Technology, written in like the early or late 90s or something, or early 2000s. And it's a great book, and I'd encourage anyone to read it. I leveraged that book for a lot of our content that I put in our value investor course, which is our online investor training course. And basically, the way I think about it, and this, I'm going to try and just pull out one thing to add to yours rather than just reinvent it. But what I try and do, because we tend to invest in technology companies or companies that are, they're predominantly B2C technology companies, but also B2B, is one of the things that I try and do is identify businesses where standards or infrastructure are being set. And so what I mean by that is, oftentimes what happens in an industry when it's early is that everyone has great ideas about how it's going to be done. But there will typically be one company or two companies that set a certain standard for that industry. So Afterpay might be one for buy now, pay later. It's set a standard of kind of what the minimum hurdle is and how you do credit checks without credit checks and all that sort of stuff. But a really interesting one in Australia might be Ordinate. AD8 is the ticket code. And this is the book that I instantly thought of when I was reading The Guerrilla Game. And this basically is an audio-visual company that allows other device makers of like PA speakers in like buildings or shopping centers to basically turn a cable. So I'm just going to hold up my Zoom recorder here, just like a standard XLR cable here, into a smart cable and basically run it through Ethernet. So audio-visual through computer networks rather than through just analog cables. And so that basically turned it into smart products. And what device manufacturers would do is add the boards and add the software to the Dante software to their manufacturing process. So basically you would have a Dante enabled device, and then all of a sudden you can plug and play onto any smart network. So a device that's typically dumb in air quotes now becomes smart thanks to Ordinate. And what we tend to find is most industries tend to emerge with a few winners, not necessarily one. There might be one outright winner, but then there might be second and third. You get the podium finish like in the F1. And basically what I'm trying to do is figure out where are the people who know what they're doing, where are they moving towards, which of these standards providers are they going towards? And I think one of the easiest things investors can do, particularly in technology, is jump onto websites like Stack Overflow or GitHub or any of these websites where developers loiter and ask questions, the really good questions about technology. It might sound really geeky, but one of the things that I do is I kind of just check out those developer forums, because if developers are building their solutions into whatever platform they're working on. So let's say it was a really good one here in Australia would be Xero, the accounting software. So you didn't need to get super geeky in terms of the developer forums, but you could have, and you could have seen that the API documentation was brilliant. A lot of people are talking about it online. How can I have my HR software talk to Xero? Everyone's using Xero. How do I talk to Xero? I need to talk to Xero to get more customers. And then that's when you would have seen that not everyone was using Xero. They weren't using MYOB because that was the future. That was the backbone of accounting. And so that's an interesting way that you can try and put your finger on what people are working on. So you could do this with Cloudflare right now. You could jump onto Stack Overflow, you could jump onto wherever and see what are they talking about. Is that forum much more active than, say, the Fastly one or some other random, Joe Blogs CDN cyber business? And then you can look at things like Facebook communities or online communities where people who know what they're doing tend to be talking about these things. And that's so like, I'll give you one more final example just to hit this home. When I build websites or I build tools or whatever, when I'm doing I'll call it air quotes programming because I don't actually do a lot of the development myself. But when I do it, the very first thing that I look for if I'm looking at using a third-party solution is go straight into their support and straight into their developer forums. Because if that community is alive and they're actively responding, it means there's kind of like enough support there to build on that platform or build on that ecosystem. And that means that I'm more likely to use it because I know that there's a community around it. And that is a powerful thing because then it feeds on itself. If you're looking for platforms, if you're looking for companies, like everyone has to integrate with Xero. At the end of the day now, it's de facto. If you're a HR solution, you don't interact with Xero, I tell you what, no one's going to use you. So, and that is how I look at rapidly growing industries and how things coalesce around leaders. Look at that infrastructure, look at the standard, and there's a practical takeaway from this podcast of how you can do it. That's basically my golden tip on this. I don't know if that helps.
I love it, actually. The two things there, basically look at the infrastructure or the market evolving around a company. And number two is basically, number two is very software specific, right? Which is basically looking at companies that are loved by developers. That's actually a great sign. Companies loved by developers usually tend to be great companies. Yeah.
And it's like if you look at, say, if you look at financial data companies, a lot of developers prefer to use CapIQ over some of the other tools in the market like Morningstar. And there are reasons for that. CapIQ, I don't use it myself, but if you're building a technology app or website, most people integrate with CapIQ because it tends to be more friendly. And so it's going to be more supportive than the Morningstar API. So these are some examples of like, well, obviously, if people are using it, that's what you want to be. And I think, to be honest, I have this belief, and this is kind of shallow, just kind of throwaway lines, but I have this belief that kind of the next 10 or 15 years of technology investing is going to shift away from B2C and more B2B. If you understand the deeper compute and the deeper problems that need to be solved in our environment now, I think you're going to have a much better chance of finding great companies earlier. And so that's, again, a software specific, but I think if you have that skill and that ability to get a pulse check on the latest core infrastructure, you're going to have an advantage. So people like yourself, for example, that have a PhD in these things might actually dominate going forward. So good news for you, mate. But that brings us to the end. Julian says FinTwit can be a useful tool too. People like Muji at Hypergrowth. Yeah, Hypergrowth is awesome. If you haven't checked out Hypergrowth, a great follows for Insight, Julian says, who has certain cool tech windows. I think there's another one called Full Stack. Julian, you might know in the chat. Full Stack.
Is it Full Stack or software investing? I think software stack investing or something like SSI.
Yeah, software stack.
That's
investing,
very good.
Yeah.
And there are a few others you can read. So if Ben Evans has got great content.
Yeah.
And if you want to read about Apple and adjacent things, then Neil Seibert has excellent coverage. Probably one of the best Apple analysts out there is Neil Seibert. Yeah, there's lots of very interesting content out there that one can find.
Yeah. And as always, one of the great places that you can go to is 7investing.com. There's going to be a stock recommendation out in the next 24 hours from Dr. Anirban Mahanti, if I'm not mistaken.
The two best places to go to would be 7investing.com and rask.com.au.
Yeah. Let's call it as we see it. So
that's what we think it is, right?
That's
Why
it.
go anywhere else?
That's it. Yeah. Come on, guys. No, we're all about sharing the love here. And 7 Investing, you can head to 7investing.com/subscribe, I believe it is, and you can use the RASK, that's RASK coupon code to get $10 off. It's already super cheap for the value that's created by the 7 Investing team for investors. So go right ahead, join, let us know what you think. And likewise, you can head to rask.com.au and you can find out more about us. Might just give a shout out to the Value Investor program that I've created. It's a good one. It's pretty easy to get through. It's a fully online program for people that want to learn how to research companies. Cool, mate. Well, next week we'll be back again, I guess, and people can find you on Twitter. Is that all right? Yeah.
That's the only place really online social network that I'm on. I haven't learned my TikTok dances yet, so yeah. in time, the 7 Investing marketing team will be like, listen, you're the best dancer in the team. We've got to get you out there. Exactly. Find us on Twitter. At Owen Rask for Owen. At 7A Mahanti for myself. But again, just interact with us, even if you don't subscribe to our stuff, that's okay. We love answering questions, love having a chat on Twitter, exchanging ideas, and maybe you can pitch us your best stock ideas and we can see.
Yeah, that'd be good. Yeah, that'd be great. If you want to share your research with us, by all means, please go right ahead and we can talk about it even next week. So wonderful, mate. As always, thanks for taking some time to join me.
Yeah, thank you very much.